The following is a presentation of TFNN.
Hello, and welcome to the Options Hour on TFNN. My name is Victor Jones. We've got a full hour of options content for you. In an interesting week indeed. Obviously, following the holidays, we want to appreciate or send a thank you and appreciation to everyone out there for listening in, joining us, and most importantly, asking the questions. Again, as you know, it's a full hour of answering any option question you have. So maybe you have existing positions, or you're thinking maybe you have an existing stock position and you want to know how you can use options to either repair or increase income, whatever it may be out there. Feel free to give us a call. We'll be on for an hour. If you're listening in the Tiger Den, we'll have everyone post the numbers here for you so you can begin giving us a call here. Obviously, we always want to start with a quick market update and maybe a quick wrap-up really on what we've seen over the last week before we actually jump into some of these positions we've been looking at, monitoring, and even putting on over the last couple of weeks. So, as a quick update, obviously the S&P 500, 1201, actually 12,003 quarters, up $9.75. So, interestingly enough, we're sitting right now right at the 1200 level. So, 1203 quarters, up $9.75, and the S&P 500 future, which would obviously make the Dow 11,603. Little bit of divergence there between what we saw before. 11,600. We're up $102 on the Dow. And for those of you who follow the Russell as well, just to give a quick update, obviously, the Dow, $697, even down 10 cents on the day. Not much movement in the overall Russell and the Russell 2000. To give an update on the commodities, obviously natural gas. Let's start with gold first. $16.90, up $2.40. So obviously we made that huge move to the 1800 level, and as all of you have been listening to this show as well as Tom's show, you kind of predicted pretty interesting and rapid move to the downside. As we saw a few people offloading tons of gold, and you saw that quick move down to the 1700 level, and obviously on a little bit of a recovery here. Crude, $99.60, up $1.40. Big move in crude today. We're going to talk about that just a little bit. Again, rapidly approaching 100. We did this before. We came up on $100, again, heavy psychological resistance, and we kind of made a move. Buyers were unwilling to take us past that $100 mark, but we are rapidly approaching it. We want to talk a little bit about that move here in a bit. Natural gas, $3.59.5, up about 6.5. So, again, for all of you that want to give us a call here to the Options Hour, our number 877-927-6648. Again, 877-927-6648. Let's talk, obviously, about the retailers really quick, because that's something we talked about last Tuesday going into the holiday season. I mean, and the assumption was last Tuesday when we talked, and amongst all of the kind of the political whirlwinds that are going on right now, and all the things that are affecting the global economy, that the assumption was that the retailers would show up, the consumers would show up, and I think we looked at a few things in terms of the XRT, which is the S&P, basically a spider S&P ETF that tracks the retail sector. And if you're not familiar with that ETF, basically, I mean, the main holdings are companies like Aeropostale, Barnes & Nobles, Hibbett Sports, Rent-A-Car, Kohl. So it's a good kind of mix of retailers. For the most part, 30% of that ETF is really invested in apparel retail, and the rest of it's split up between automotive retail and specialty stores with some other holdings in there, obviously, to mix up or to add some diversification there. But in terms of what drives that ETF, it's majority apparel retail. So we looked at where we were in terms of price, and XRT, for everyone out there listening on the radio, trading right around $50, $50.11, down 6 cents on the day. But, at that time, we were actually closer to $48, when we last talked, right around the 50 level. And we said, we'd kind of been range bound between the 52 and 54 level, and if the retailers or if the consumers show up, this could be an interesting play. And you saw a bounce off of that $48 range or $48 price to the $51 price action yesterday. And if you listen to our quick wrap-up that we had, Steve Rhodes yesterday around 4:30, the question was, and we'll go over a couple more trades here, the question was, what do we do with those positions? Obviously, we talked about, some bullish positions in a few retailers, and we want to talk about exactly if that was something you chose to participate in or if it was something that you had already had on. How do you manage those? And we talked about, yesterday feeling like that nice consumer surprise was probably a little bit overdone and to probably take off those positions. And as we look at a few of the other retailers, you'll see that we pulled back just a little bit. So as we're moving into TIF, which is Tiffany's, another one of the higher-end retailers we talked about, we said, it could be interesting, and if the consumers show up, in the general retail sense, XRT could have a nice move, but the better bet is that the higher-end retailers will have, a nice couple of days here. And again, if you want to give us a call, it's 877-927-6648. And interestingly enough, the initial numbers were that about 9%, or we had an increase of Black Friday shoppers of about 9% year over year versus last year. And I think the number's been revised somewhere around, I've heard numbers right around 5.7, anywhere from 5.7 to about 9%. And that the online shopping increased about 25%. So we're still getting, looking for those numbers on Cyber Monday. There's been some initial reports, but we'll kind of wait for those to be confirmed. But interestingly enough, obviously the consumers showed up, but they didn't show up in the brick and mortars. And, the places like Best Buy, the places like Walmart, the places like Target, obviously you could see the consumer traffic. But if you went elsewhere, interestingly enough, just anecdotal evidence, the stores didn't look that full. But again, that's because about 25% more of people were making those online purchases versus actually going out there to those brick and mortar stores. So, I think it's interesting that we could have that amount of increase where you have very targeted purchases versus going to a store where you kind of make some, obviously some ancillary purchases, but that we still beat the numbers that we had last year, indicating obviously a little bit more positive consumer sentiment. So this morning, as we give a quick update, obviously consumer sentiment data was released here earlier this morning, and they were good numbers. As you can see, the market is obviously responding positively to the numbers that we had. But again, the conference board said that the index actually rose from 40.9% in October. That's, if I'm rounding here, 41% in October up to 56% in, in the last month. So clearly a huge jump, the highest level since July, but obviously we're still at around historical low levels. I think the high or the peak was back in February when we were at a high of about 72%. So still got a ways to go, but interestingly enough, again, consumer sentiment had a huge jump this morning, which is giving the market a nice pickup along with the numbers that we saw yesterday. Now, back into the trade that we talked about. Let's talk options here. TIF Tiffany's was trading right around the 70-72 handle, and what we talked about was looking at the 67.5, 65 put spread for Tiffany's. And again, just to walk through what that would be, selling the 67.5 put and buying the 65 put behind it, which would have brought us anywhere, right around $60 to $70 for every one time you put that on, which would leave you with about, $180 worth of risk. So you're basically trying to make, $60 to $70 by taking on $180 worth of risk into December expiration. And the move that we had yesterday was absolutely, fantastic. Clearly, we've had a gap down, a little bit of profit taking here, even into a strong market. So you see there's a little bit of rotation out of retail, at least from yesterday. So we had a move from $70 essentially on Friday up to $75 yesterday, which would have gave a great opportunity to actually close out that put spread for a significant profit, at least half of the contracts that you had on, if not all, which is what we talked about yesterday. And the last retail position we want to quickly mention here, guys, is Coach, which also gave an interesting opportunity. We're trading right around the 58 level. We talked about looking at the 56, potentially the 58, the 58, 56 put spread. And, again, we came down. We sat right around the $58 level. We had a $4 move to the upside, trading a little bit over $62 yesterday. Gave a great opportunity to actually exit that position as well. So, we just wanted to obviously go over some of the things that we were able to talk about last week. Clearly, we don't want to be talking about positions that we don't follow up on. So we want to make sure, obviously, we're always coming back to talk about those positions. Another couple of interesting things that we had mentioned last week, LUV, Southwest Airlines, with high implied volatility. We thought this was an interesting kind of level, right? We were trading right around $7.60 when $8, you can see, built up a pretty heavy, it was a pretty heavy support number. And so, Southwest has shown us it could break down below that $8 level, and it did. 2 expirations go down to the $7.15 level, but that happened mid-expiration, and it found its way above $8. So we took a look at potentially selling that $8 put, potentially with the $7 put behind it, to limit your capital exposure there or wrap up some of the margin you might expose yourself to. But again, as you can see, we made a move from around the 740, and we are now at $7.92. So, Southwest up about 5 cents. That's 0.5% on the day. Not the most, not the most beautiful sector to be in, especially in a day like today. AMR, if you've been tracking the markets here, especially the airlines, traded down, from $2 on Friday, basically to about 80 cents or somewhere around there, and now today is trading right around 35 cents on bankruptcy news, as well as the appointment of a new CEO. So that said, interestingly enough, could bring on some, the assumption there is that those customers potentially might. They have to go somewhere, and if they're not with AMR, which doesn't mean they're going out of business, they're just filing for bankruptcy protection, obviously that could potentially make Southwest as a company look a little, even that much stronger. As you kind of saw with the whole Blockbuster and Netflix kind of inverse relationship for a long time. Interestingly enough, $7.92, the position there again, and it's still there. At some level, definitely is still available. Now we only have 17 days to expiration, but if you do look at that 8-strike put, selling that put brings in about 30 cents, and your risk on return is about 4%. Your probability of expiring above that level is actually now above 50-50. It's at 57%. So we're going to wrap up, just a few more trades. Again, we'd like to take as many calls as we can here for the hour. That's 877-927-6648. Talk to us about anything. New positions you put on, positions you're thinking about putting on, stocks you like, stocks you hate, futures you like, futures you hate, commodities. And we want to look at them from a high probability standpoint. And actually, we're going to be talking about a modified covered call position, which I think is interesting for anyone out there who's actually trading stocks today. Clearly, the S&P 500, we were just recently trading 1260, 1275, the upper end of this range. If this move down to 1200 has hurt you, we want to talk about, how do we generate income but not limit our upside potential. So that's coming up. But please feel free if you have any questions, 877-927-6648. The other one was a very, very speculative play. So we took a look at Southwest trading a little bit below $8, and we thought that would be an interesting play from a probability standpoint. The one we kind of took a shot at or looked at, potentially was this Frontline, FRO, trading with 190% front month implied volatility. That's 180 in the back month. essentially if you were to sell the 3-strike put, you're bringing in about 45 cents. At the time, it was trading a little over $3, and the put was worth 30 cents, meaning you were decreasing your cost basis there in Frontline by 10%, basically by selling the put. So essentially, if you had sold that put last Tuesday, clearly Frontline has sold off just a little bit more, now trading at $2.79, but your effective cost basis is somewhere below $2.70. You still got some room to play. So that's a very, obviously a very speculative move, but it was out there. So now, let's get into the modified covered call position that we want to talk about. So again, this level shift, and I'll bring it up so everyone can see. Essentially, we traded it as a low of 107 in SPY, the spiders which track the S&P 500. That'd be about 1070 on the S&P. We traded up to, as you can see here recently, we traded up to a high about 129. That's 1290 in the S&P, just roughly, right? We traded up to almost 1300 before, again, kind of rolling over. The market, we didn't have buyers there. Volume dried up just a bit. We rolled over, and we came down and looked for that 115 level, or basically the 1150 level in the S&P. And now you can see we've retraced. So basically the market from that low 107 up to about 129.30, a retracement of that move of 62% would have put us right at the 115.66. So we didn't quite get there. We got very, very close. We made kind of this hammer, so to speak, at 117.70 on 11.25. So from that level, we have moved up from a 62% retracement. We're now approaching where that 38% retracement level would be, which is about 120.88. We might expect to see a little bit of resistance here. But again, that's still a basically 38% cut from where we were at the beginning of last expiration. So essentially, month over month, the market has cut off about 38%, or retraced its move, I should say, 38%. Didn't cut off 38%, it just retraced its move 38%. So from basically 130 to the 120 level is where you're potentially sitting. So for those of you that took long positions there, long stock positions, or even long, if you're long premium, that's a different story as well. But if you're long stock there at the level, how can we repair or bring in income in some way on those positions? So what I'll ask those of you in the Tiger Den to do, if you're in the chat room in the actual Tiger Den, and I want to say hi to all of those who are participating. We've got a good number there. Could you go ahead and type in a couple of symbols that you've been looking at? So guys, type in some symbols. We want to take a look at some stock repair. So if any long stock positions out there, feel free to go ahead and type it in here in the chat, and we'll go ahead and pick those up to use. So give it just a few moments here. Interesting positions coming in here. We've got one for Oracle as well, so we might use that one. Thank you, Angie. Boston Mark says use Procter & Gamble. Interesting. So we've got potash as well. Depends if you're on the north side of that friendly border. I suppose it's potash, and if you're on the south side of that border, I suppose it's potash. So I've heard it pronounced both ways. I guess it just depends on what side of the border you're on. So I think we've got some great examples. Thanks, everyone. Thanks, Boston Mark. Thanks, GL. Thanks, Angie, Rhodes, Axman. Thanks, everyone out there for giving us some great examples. I think we're going to start here. We're going to get started here with Oracle. I think that's a good recognizable name. Oracle here, the ticker symbol out there, ORCL, $29.93, up 6 cents on the day. That's about 1/5 of a percent, 0.2% on the day. So interesting patterns that we're seeing. I mean, from a stock perspective, guys, from a stock chart perspective, if you're a technician out there, you gotta be kind of scratching your head here. And you say, every chart I look at looks almost the exact same, with this run-up through October, a range-bound market through last expiration, and a break into the beginning of this expiration cycle. Literally, Obviously there's some exceptions to the rules here, but essentially every chart we look at is going to have that same pattern, and it's going to match up very, very closely to the S&P 500. And that's what we talk about, utilizing the S&P 500 as a potential hedge, at least as a barometer for where the market is going. If you're not sure, or if you have, a certain prediction on the market, whether it's a downside break or not, and you're not preparing for that in your underlying securities, you could be in a little bit of trouble. So great suggestion here, but let's go with this, Angie. We're trading at $29.93, and that is a retracement from its higher level just last expiration. It traded in a beautiful, beautiful range from an option trader perspective of about $31 to $34. And any iron condors or short puts, short call spreads, short put spreads, those would have worked really, really nicely throughout that expiration cycle. And now I think what potentially Angie and a lot of us out there, looking at here, especially with Oracle, is, hey, these things were high flyers, especially the tech sector over the last 3 months, and you saw a quick break to the downside, and you potentially caught in a higher cost basis level. How do we bring in income there and not actually give up potentially some of our upside potential? So if you're familiar with a covered call, I'll just bring this up so that everyone can actually see how this works. And, for some of you out there familiar, just stick with us here. We're going to get a little bit more complex, if you want to call it that. But Oracle's now trading at $29.93. The assumption that we'll make here is that you already own the stock. Now, this could work if you already own the stock or you're looking at potentially purchasing into the stock. So if this is, or, and the strategy itself can work across instruments, so not just Oracle, but it's the strategy that's really interesting here. So if we're potentially go long Oracle, or if we're already long Oracle, we can see from a probability standpoint, the probabilities that we trade from now until December above $31 is only 32%, meaning 68%, or the expectation, or 68% of the time, given current price action and current implied volatility, that we would trade below $31 from now until December expiration. Okay? So we're trading at $29. You're long or potentially thinking about going long, but the upside here is, the upside potential is at best $32 between now and 17 days from now. So the question is, well, if I'm caught here at potentially $33 or $34, $32, $33, or $34 on my cost basis, how do I essentially bring in some income there to ease that? Maybe ease my cost basis and make this, position myself for a nice January move, potentially. So the idea here is, if you were to go out and sell the 31 call in December, you would take in about 56 cents. In other words, you take in $56 for every 100 shares that you're long in Oracle. Okay, and so from a covered call return, from a covered return perspective, you bring in about 18%. And if the market moves up all the way to your strike but doesn't surpass it, you have the ability there, your max covered return. If the market moves up to $32 and you've taken the premium on an annualized basis, you're talking about 110% return on an annualized basis. So what this essentially means is you could go out and sell the 31 call for 56 cents. But if we look at essentially what that does to our potential profit and loss, I'm just to show everyone out there what this looks like. Let's just analyze this trade. You can see that if it does, in fact, trade above the 31 level, and we're looking at the 31 call here. If it trades above the 31 level, you can see that we max out our profit. We'll never make more than the difference between 30 and 32, which is what we can make on the underlying, and basically the credit that we'll receive, which is about 56 cents. We'll never make more than that. So you can see here our max profit on this potential position is about $164 for every 100 shares that we're in. And for people that think, hey, you know what, we've seen a range-bound market here, we know at 34, there's a potential there for the market, if not from now to December, but from now to January, to actually break above. There's the potential there, to give yourself a little bit of room. So I'm going to change this from 6 months to 1 year so you can get a little bit more context in Oracle's movement here. And you can see that Oracle at its high traded all the way up to 36.5. So the idea is, how do I take in some income but don't limit or cap my upside? So I want to show everyone here what this might look like. So I'm just going to buy the underlying stock. On our Analyze tab, I'm buying the underlying stock here. And in December, I'll show what this looks like, and I'll do this in January as well. I'm going to sell that 31 call just as I did before. What I'm also going to do is buy some cheap out-of-the-money call. So basically, it's a vertical call spread that I'm creating. I'm going to buy that December 33 call. We'll go to the risk profile, and I want you to look at actually what happens here. So you can see, instead of bringing in 56 cents to sell that call, I've decreased it. I'm now only bringing in 43 cents, but I want you to look at this risk profile. The assumption is that we've just level shifted to the downside, but there's still upside potential between, let's not call it now in December. You can see now in December there's some room there. But we think longer term there's the potential for us to make a little bit of money here. You can see what this has essentially done to my risk profile. By selling the covered call spread, that long out-of-the-money call essentially gives you some upside potential. So if the market moves above the 33 level, I've no longer capped my upside potential. I actually have even greater potential to the upside. And so for those of you who are actually long stock right now, this is an interesting, I don't want to call it repair strategy, because I think in some cases, it's not used in like we would use maybe a ratio spread or a back spread or something like that. This is used essentially when you have just a bit of a level shift and you feel we're at some sort of support and you feel there is some upside. There's still a lot of upside potential in the underlying security. And so I want to show something we showed December, but I want to show actually how this looks if we use something like January instead. So I'm going to add just a few more strikes here to the option chain so everyone can see. What I'm essentially doing is I'm going out and picking that same strike. I'll actually select one a little bit higher. No, let's use the same strike. We're going to use the 31 strike in January. We sell it at $1.14. And what we'll do, again, we're just buying a cheap out-of-the-money call. We'll buy at the 34 level, let's say. You can see here, bringing in double the amount of capital, 83 cents, and you can see actually what this looks like. Again, looks very, very similar here as long as I'm long the stock and I've sold this vertical spread, what this actually does for me between now and January expiration. So it's just a very interesting concept, guys, that you can utilize in your own trading. And I think for those of you, I think there's a lot of people out there that say, I'd like to sell a covered call, I'd like to bring in some income, but I don't want to limit my upside potential, even though the probabilities give you a very, very good chance of taking in that income, and depending on the strike. As we've seen, the market can, just yesterday, we had a 30 to 40 point move in the S&P 500, and those are not the expectation, I can tell you. And in those instances, you will get a nice move in the underlying securities as well. And so if the nervousness there, so to speak, is that you don't want to miss on any upside move or large potential upside moves, you can do what's called selling a covered call spread. So what I think we'll do here is we want to look at a few more. So we had a couple great examples here in addition to Oracle. Let's look at PG, Procter & Gamble as well. Interesting kind of staples of the marketplace here that we're looking at, but again, same pattern that we're seeing, very similar pattern, not as strong in the last expiration cycle. But you can see a move up to the 66 level, downtrend last expiration cycle into the 63 handle. We touched the 61 handle in this expiration. Now we're tracing back to the 63. I think 63 is going to play an interesting support level here, as it did in the previous expiration cycle. But again, if you're caught in a level shift, and that is from a $66 to a $63, $3 move in a $66 stock is a 5% move. I mean, if you're looking at ways to potentially lower that cost basis, let's look at some ways we can do this. If you're not already long here, again, selling a put or selling a put spread is an interesting way to get a little bit of bullish bias here. And the 62.5 put in December is paying out 84 cents. So again, from a risk on return perspective, that's about $1.37%. So looking at selling the 62.5 put, that's 84 cents, basically $84 for every 100 shares we own. You take in risk on return, 1.36%. Risk on capital, the actual capital you would have to put up is about 7%. You can clearly see. So in that case, just to break this down for everyone, you're at the 62.5 strike, which essentially means you're bringing in 84 cents, which basically means if the stock trades down to $61.70, that's your break-even point. If it stays anywhere above $61.70, you'll essentially bring in that 1.4%. So again, for those of you, we've talked about our covered call or selling the covered call strategy here. It's kind of an interesting income play, limiting a little bit of that income to basically give yourself a little bit of an upside shot if you feel, again, we're going to have a rapid move in that underlying security. And sitting here at the $1,200 level, I think there's an interesting upside. There's an upside potential here to potentially rally into that 1,300 level in the S&Ps. Now, that said, again, we always want to use risk-defined strategies. Risk-defined strategies so that we understand the risk-to-reward scenario, and we want to do that in a high probabilistic manner. So we've talked about just that today. If you want to give us a call and talk to us about your positions and talk to us about potentially your adjustments, whether it's stocks or whether it's options. Let's just talk about underlyings if you want to do that. Give us a call at 877-927-6648. So I think what we want to do here, we'll look at just a few more examples here, guys. We had Oracle, Procter & Gamble, and Potash as well, POT, trading at $42.43, up 20 cents on the day. That's about 0.5%. And if we take a look, essentially, again, always want to start with that action. We see very similar chart action to what we see in Procter & Gamble. Again, traded as high around $50, now trading at $42.40. So again, you saw a level shift of about $8 here in this underlying security, and if you were lucky enough to get caught in this security about 3 expiration cycles ago, trading as high as $60. So depending on kind of your cost base in this underlying security, your repair or need for repair could be quite great. So here's what we want to look at here, potentially in Potash. Again, same type of strategy for long the underlying stock, and we're selling potentially. Always want to look at the probabilities here. The probabilities that we get or that we trade above $45 between now and December expiration. Again, we're trading $42.40. The probabilities that we get above $45 is only 25%. So there's a 1 in 4 chance we get above 45. Clearly, that means there's a 75% chance we trade below it, which means that 64 cents, which is available now on that 45 December call, is available on a $42 underlying security. So if we just, again, let's just look at this, at what it looks like if we're buying the covered stock here. You can see I'm going long. My break-even is right here, about a $41.79, excuse me. And as soon as we start trading above $45, I'm obligated to sell stock at the $45 level, and that's where I've essentially maxed out my return. And so on the opposite side of that, if you're long, definitely here, if you're long, definitely at the $50, $52, $57, or even $60 level, giving up I think the profit potential at $45 for some people is a very scary prospect. So again, the idea, or what we can utilize, what we can do behind that, go long the underlying stock if you're not already, and we're going to still sell the $45 call. But what we're also going to do, again, is just buy a cheaper out-of-the-money call to turn that into basically a bull call spread. It's basically a bear call spread, but you get that cheap out-of-the-money option is actually going to work in your favor as it goes deeper and deeper into the money. So I'm going to buy that one behind it, the 50, and take a look at what this actually looks like. So you can see, again, at the 45 level is where I start to taper off. But again, if we make a move above $50, you can see, again, I now start to profit again. So you can see, again, here, my upside potential on 100 shares, about $369, anywhere in between the $45 to $50 level. Anywhere higher, though, you can see, again, I'm starting to participate in that upside move. So I think this one, more than the others, is a very interesting opportunity, especially for those of you who have that cost basis that's significantly higher than the current market. It's just an interesting way to bring in income and not limit your upside potential. And that, ladies and gentlemen, is the covered call spread. With that, we want to talk just a little bit about the VIX. I don't think, we haven't had a chance to really talk about the current VIX level and what the VIX is actually telling us here. And, I think we make it a point, essentially, to talk about the underlying market and the inverse relationship between volatility and the current market. And what we've always noticed is kind of these levels, these oscillation levels between the VIX and the S&P 500. Clearly, 1200 is going to be a huge psychological level for the S&P, support level, and kind of where we are here. So again, you saw an oscillation between the 15 and 20 level, which was, or basically the 15 and 22.5 level, before the market kind of turned over a little bit and showed us basically a new range between the 47.5 and 32.5 strike levels, which is where we basically were for about 2 months. And now you're seeing a new range essentially being established, and that range is really, depending on how tight you want to draw it, I'm going to call it 27.5 to 35 in the VIX. So we are now at 31.16. We're down about $1, down 3%, down 3% in the actual VIX today. If you saw what the VIX did yesterday, it essentially crashed down below 30, almost touched 29 between closing, relatively close to where we opened yesterday. But a very, very interesting move, and told us, throughout the day, as we move closer and closer to $40 up in the S&P, people were relieved in terms of buying protection. And then, as the market kind of gave up some of those gains, and we closed somewhere around $30 up on the day, gave up about 10 points to 25% of the move, is when you saw some of those put buyers come back into the market. But again, we're now right around that $31 level, which if you're looking at this range, I think is approaching, at the $30 level in the VIX, approaching the lower end of volatility. And so essentially what that's telling us is that it could be a cheaper place to buy premium versus actually looking at selling premium. Now, for those people utilizing covered call strategies, I still think this is an interesting kind of midpoint of the range to sell some of the premium and still on the put selling side. Or for those of you who are utilizing spreads, so selling call spreads, selling put spreads, what could be interesting here as we approach the $30 level is to basically use the inverse. And that is to start looking at buying or looking at going long in the money spreads. And what happens is, instead of buying out of the money spreads, instead of buying some out of the money spread, and I'll give you just a quick example. We'll look at Apple. So if I liked Apple here, the tendency here is to potentially buy, let's say, the 375, 380, call spread. And in doing so, you'd basically pay $2.20 to do that. Well, that's all extrinsic value. That spread is not worth anything because it's not trading above 375. But now, if you look at it, Apple's trading $371, let's call it. The 365.370, which is in the money. It's completely in the money. You could buy that for $2.95. So basically, your upside potential there is about $2. So even though it's a long call position, even though you're technically long options, because it's in the money, it's a positive theta trade. And that is, basically you're just waiting for these calls to expire. The longer and longer Apple stays above 370, the more, or the closer and closer you get to expiration, the more and more that spread will widen out to $5. So I say that to say this. When you get an underlying security that's trading in between two strikes, in this case 365, 370 in Apple, an interesting spread opportunity there is when it's trading right in between those two strikes at 367 and a half, especially in a low volatility market. That can potentially offer you a cheap way to get into a spread that has some intrinsic value. You're not paying a lot for extrinsic value. And in addition, because you're long the spread, if volatility increases, you'll be long Vega. That will help you. And then at some point, once you start to max out that spread, at that point you're just waiting essentially for that spread to open up just a little bit. So that's an interesting basically opportunity as we approach December expiration. You're looking for January opportunities, and if we start to trade down near that 30 handle, looking for securities trading in between strikes to potentially go long, and looking for, again, a cheap way to get some intrinsic value, but still at some point have positive theta, or basically so time decay can work for you. That's an interesting way to potentially look at doing something like that. So again, as we wrap up the show here in the last 12 to 15 minutes, feel free to give us a call with any of your remaining questions at 877-927-6648. We've got a question in the Tiger Den. Can we talk about 3 times options, like TNA, and any strategies you'd recommend for those? So I've got, I like to address these. And for those of you trading options on leveraged ETF, God bless your soul, because leverage on leverage, is an interesting concept. So yeah, let's definitely talk about that. I appreciate it, G7, for the recommendation. So what everyone has to understand about these triple leveraged ETFs is essentially their makeup, how they're made up mathematically, and they're designed mathematically to duplicate or replicate to a certain extent some underlying security. So if some underlying, let's just call it the Russell. It's not necessarily the Russell. It actually tracks a different small cap fund. Let's call it the Russell. It performs, it's up 2% on the day. So what TNA would, or any triple leverage that was tracking, let's say, this underlying security, it should be up around 6% on the day. And because mathematically it resets every single day, it's going to be tough to track that over time. So if you're charting some underlying security, whether it be the Russell, whether it be some small cap fund that you're actually trying to replicate, from a charting perspective, it's difficult to actually to trade from a technical perspective, again, because mathematically it's going to reset every single day. So derivatives on top of that make it a little bit more difficult to do, but I think I understand the appetite for these because of the high implied volatility. We talk about that on the show all the time. We talk about looking for implied volatility. We talk about, taking advantage of basically that rich premium. But I think when you're doing something like this, I think you have to be very, very smart about the levels and the aggressive nature in which, or the aggressive stance that you might take in a security like this, and I'll explain. So just from, and this is something, I track the Russell, but not TNA 100%, but we can clearly see we've got a little bit of support here at the 30 level. We're trading right around 38. So 30 level, again, this is a 3-time leverage to the upside. It's a bull fund. And if you feel here at the $1,200 level, it's an interesting support level in the overall market. You might feel a little bit more comfortable using TNA because you can get further and further away from the market given the implied volatility. Now, because of the implied volatility, from a probability standpoint, you have the same probabilities that would go down and touch your strike than anything else. But, from a, trader psychology standpoint, you might feel a little bit better if you're 6 points out of the money versus 2 points, and I get that. So here at $38.45, up 6 cents on the day with 17 days to go till expiration, I want you to look at how far we can get out of the money with something like this. The probability that we actually go down and trade as high as $46 is basically, it's basically only 16.5%. But if you look at the vertical spread on a 1 point wide, you'll get 15, you'll basically get 15 cents for that. So you can see we're still priced exactly how we should be. About 15% means there's 15 cents means there's a 15% chance we trade above 46. From a support level, we can look at something that's very, very similar. We can get about all the way to the 29 handle here. If we sell that 29.28, you can see 15 cents. So from a probability standpoint, G7 and everyone else out there, we would utilize the same risk rules that we always use. And for those of you out there, I want to make sure everyone understands, if this is the first time you have looked at selling spreads or it's something you're considering, I think it's important that everyone understand those parameters. And when you're looking at selling a spread, there's a couple things that we look at, and one is probability. If you don't have probability in the software, if you're not lucky enough to be using ThinkorSwim, you might look at delta as a proxy. And depending on time to expiration and where interest rates are, it could influence that just a little bit. But delta tends to be pretty close. And essentially what we're looking at is one standard deviation. So 68% of the time, if something were to occur, that's called one standard deviation. So if you were to look at delta, basically you're looking for a 30 delta option. And the flip side of that is about 70% chance that we won't touch that particular strike. And so in this case, that 30 delta option is probably going to be that 32 or 31 strike there in TNA. And I'll put on delta for everyone so they can see it as well. A little bit closer to the money yet because we're closer to expiration. But here, you can see at the 31 level, if we were to sell the vertical spread, you get about 20 cents, which means there's a 20% chance of basically staying, a 80% chance that we stay above $31 between now and expiration. So we're trading right now $38.50, and we're selling a put spread, 31-30 strike put spread for 20 cents. Which means the market would have to move the entirety of basically $7 to come down and really affect us. And $7 in a $39 stock is an absolutely huge move. And if you also look from a charting perspective, its support is really built right around the $31. Now, it quickly touched 26, but if you look at that actually only happened over the course of 2 days. And if you actually look at the price action here, for the majority of the time, 31 looks like a very, 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 solid support level. So G7, if you're actually looking at, hey, what kind of premiums are you looking at? I think because of the difficulty utilizing options on a leveraged security and how that resets on a daily basis, I think 31 is an interesting support level. It gives you 80% chance of probability. You're risking one. You're risking 4 to make 1. And, I think when in terms of trading these, I tend to be more conservative, which is kind of interesting to people because it's an aggressive instrument, but you utilize a conservative strategy. But in doing so, a 3-time leveraged move. If we get a nice little uptick here in the small cap securities or in the overall general market, clearly that put spread, that 31-30 put spread could go out of the money or deeper and deeper out of the money quicker and quicker. And, G7 says you know your risk, and I think that's exactly right. you put on something, you understand the risk, and again, I think there's an opportunity here to be a little bit more bullish. I think more aggressive. I think aggressive plays in leveraged securities using options, you have to be a little bit more short-term in nature. It's tough to be very aggressive in these types of securities that refactor or reset on a daily basis. And in being conservative with these, it allows you to basically let time work for you, let the trade work for you, and not have to worry so much about that refactoring on a daily basis. So we talked just a little about TNA. There's a couple of these out there in the ThinkorSwim software. If you use it, you can actually find all of the double and triple leveraged ETFs. We have lists for all of those. So if you go under public, you've got double long, double short ETFs, and we've also got triple leveraged ETFs as well. So, I know another couple of those that have been fairly popular, FAS and FAZ. And I think here, in terms of financials have been, hit pretty hard over the last expiration cycle. And I think, the 40 level in FAS is going to be pretty, is obviously pretty interesting. We're trading right around $53 here. $42 is really the low. But again, that happened over a two-day period, essentially. So the $45 level in FAS is really where your main support is. And I'm guessing if we look here at how those options are trading, we'll probably get about that same risk to reward here in the 45, 44, and you can see almost spot on. So $26 for every $75 of risk that you're actually putting on. So I think the 45, 44, or if you want to go a little wider, obviously 45, 43, 45, 42, depending on how big you want to trade here, guys, is kind of an interesting level for some of those leveraged ETFs. But again, I would caution everyone out there who's looking at those, even though it's an aggressive instrument, to utilize conservative strategies because of that refactoring. Now, the other thing I want to talk about really, really quickly here as we wrap up the show, we've got about 2 minutes left here, is about pricing. If you look at the 45-44 call spread, it's 26 cents. If I go too wide here, 1 month, 2 strike, you'll notice it's going to be very close to double the price. So you can always look to widen out those strikes, save on transaction costs, and that's just a quick, helpful tip as we wrap up the show. So I want to thank everyone for joining here today, guys. We've talked about everything from retailers to triple ETFs, covered call strategies, and the like. So we'll see you here next Tuesday, same time, same place on the Options Hour on TFNN. Thanks, everyone.